Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options. Okay, stocks remaining heavy after those FOMC minutes came out, showed a slightly hawkish lean as some members favored 50 basis point hike. And also cautioned against financial conditions easing, which is not really what we saw from Powell. So to know that some of the members of the committee are concerned kind of makes the market a little bit more worried. Europe still outperforming as the recent sell-off in US stocks obviously been pretty brutal, but it's still potentially got room to go. European stocks happily still sitting up there and not really reacting just yet. Commodities still grinding lower. We did see a bounce in natural gas, but oil looking pretty weak and threatening to test the bottom of that triangle formation that we've got going on as inventory builds continue. Index vols in the US again firm, but also in Europe firming up a bit. We think geopolitical concerns are a factor here, as you know, China potentially have been offering arms to Russia to support what they're doing in Ukraine. So some sort of proxy war between China and the US. Those sort of headlines and those sort of concerns may be making people a bit nervous. So even though markets didn't melt down yesterday, vols were still pretty well bid. Commodity vols were a bit more mixed though. Oil vols slightly better bid, up a point. Nat gas giving some back, and then the metals, uranium, copper, etc., coming a bit softer. So we do see a high positive carry across most of the space. We think that's because obviously investors have rushed to hedge the tail risk. Repricing of Fed expectations have taken implied vols higher. And even though we have moved down in risk assets, we haven't necessarily done it on such a high realized vol. So you can see these realized vol numbers of 15, and Europe's still kind of around the 10 level. So it hasn't gone crazy to the downside yet. So it's more that nervousness creeping in, creating this kind of implied volatility premium over realized. If we look at precious metals, quite a lot of carry in there, suggesting that selling implied vol in precious metals makes sense. Now, if you were of the mind that this downside move in precious metals is kind of reaching a bit of an exhaustion point pretty soon, we think there's maybe 1% to 2% downside in gold, and it probably has some kind of bounce off that 1800 area. You might want to look to sell puts. Selling puts on silver might make more sense because the implied vols on silver are in the 20s. 26 versus 14 on gold. So, potentially something like selling puts on silver where you're happy to take delivery of some silver, given that hasn't really rallied like gold did at the start of the year and is kind of near some half decent entry points. You might sell puts on silver. If it goes down, you take delivery of those puts. And then if you get the premium of those silver puts, you either keep the premium or you spend that premium on upside, maybe in some calls on gold or something like that. Then you get into a precious metals long, but you do it in a smart way from a vol perspective. So those are the type of things we're thinking about. If you look at skew, quite a bit higher. Look at all these percentiles are back in the 40s. So an impressive repricing of skew over the last month as fear definitely coming back into markets. We do think the setup now is a bit more precarious because dealers are short downside, as we've been describing, and they're also short upside on VIX. So there is more risk being priced now, right? So you could argue that the implied levels of skew and of vol are pricing in a lot more risk to the downside now. So when the market is better priced for risk, it means that it's not so much of a shock now the market's going down. Now, we do think CTAs are potentially still a weak spot in this market that could trigger a bit more aggressive selling to the downside. So there is that risk. But as we come out of month end, if we manage to avoid a bit of a downside shank in markets into month end, as we get closer to March OPEX, we're going to see a situation similar to what we saw last week into February OPEX, where all those puts that have been bought and all that protection that's been bought is eroding away through the passage of time. And that time decay will then create a buyback bid of the futures that dealers need to rebuy against what they've sold against these options. So that will start to become supportive to the market. We don't see that happening for the next week or two, but we do think into the middle of March, that's very likely to happen, right? If markets haven't really melted down, you're going to start to see some support come back. Okay, so that's kind of what I'm thinking. Okay, jumping on to what charts we're looking at. So still lots of hope. So we've obviously had retail. We've had risk asset sell off. We had institutional buyers of downside. We've had skew go bid. These are all sort of typical things that we see, especially after people added exposure in January. But there is still a cohort of investors, the retail crowd, that's been using S&P weakness over the last week to YOLO back into call options, right? So JP Morgan have got this retail radar, and what that shows us is quite a large positive delta bias in terms of what retail have been doing on the call option side. So apparently they bought 3.6 billion delta versus short dated calls and 2.7 billion gamma last week. And that was like in 0 DTE to 1 DTE call options. Okay. Now, clearly the market hasn't rallied since then. So those short dated call options were just dead money, right? They were premium wasted and they were likely loss making. But that just shows you the speculation that is still happening in markets. Another indication of investor sentiment is that if you look at Google Trends, soft landing is, the searches for soft landing are kind of on the moon. Okay. So that shows that's not really consistent with a market that's bottomed out. So if we look back at 2008, early 2008, you had a lot of soft landing searches. The bottom of the market was in 2009, and that was a hell of a lot lower. Okay, so we think that whilst we may be getting close to a near-term bottom, as Fed rate expectations have repriced and do continue to reprice into the March FOMC, we think the ultimate bottom in stocks is likely still some way off and requires more damage to consumer finances. And we need to see that short-term speculation in options and in meme stocks not be so prevalent, and also in crypto, because whilst that's out there, then we think stocks have still got material downside. Okay. Now looking at S&P chart, obviously it did have a bit of a breakdown recently. It's tested that 4,000 level. We did see on FOMC minutes 0 DTE put buying in that 39.80 strike zone. It triggered dealer selling. We got a bit of noise late in the day yesterday. Those puts were then monetized. You can see that with the hero indicator that Spot Gamma point out in their daily note. But if you subscribe to their live hero indicator, you'd see that in real time. So we did see puts being bought after the FOMC, and then later in the session, those puts were then sold back and the market stabilized. And we've got that mean reversion that we've talking about, and Jim Bianco has been talking about as well, that we think these 0 DTE, the impact of so much 0 DTE flow is that you get mean reversion into the close. So close to close volatility may well be dampened, but you get a bit of intraday chop because of it. Now we've got PCE inflation up next as the next major macro data point on Friday. Looking at the chart, we've got a confluence of support here in that kind of 39.40 to 39.75 area on S&P. Below that does open up quite a bit of material downside, maybe as low as 3800. That was that target that Michael Hartnett talked about for 8th of March. Pretty specific on his timing there, but 3800 to us seems like a sensible place where there'd be quite a lot of support coming back to the market. Now, we do think markets are probably capped into March FOMC as investors wait to see if a 50 pip hike is actually happening again. But we do think Friday's becoming a bit binary with that PCE. Obviously, the market's had a bit of weakness. There's quite a lot of big support levels down here. And so it's very possible that if PCE comes in line or better, markets want to have a little bounce from here, maybe back to that 40-60 area. So we do think the scenario is a bit binary, and maybe a bounce on Friday would be an opportunity for people to add to bears if they have got some powder to do that. Looking at the strategy compass on S&P, it's screening as bullish risk reversals as the trade. We've seen a big pop in skew here. We've seen the front end pop as well. So if you have the inclination that you're willing to sell puts and buy calls as a tactical position, and you're bullish from these lower levels of spot, given that we're at the lower Bollinger Bands, that's what the strategy compass is pointing at, basically. Now, me personally, I'm a little bit more bearish. I'm personally not doing those trades. The trade that I've had on, which we're reviewing, is all right. That's it for today. There's going to be no video tomorrow. Obviously, subscribers will still get their daily note, but unfortunately, can't do a spotlight video for you guys tomorrow. So I'm going to catch you next week. Thanks a lot.